Well, certainly a lot to unpack, but we've got the perfect candidate to do just that. Saruhan Hatipoglu joins us on set. He's the CEO of BERI and CGTN's Global Economics Analyst. Always good to see you, Saruhan.
Happy to be here.
So let's start with your reaction to the Fed's rate cut and the reasoning behind it.
I think it was expected. The press conference that was given afterwards, though, was very good. Mr. Powell was really on to the point that he was making, and I think the point that he was making is just that little change in the language, which might not mean a lot to a lot of people, but changing the word "act" appropriately to assess the path. We're actually on the path right now. That assessment issue tells us that they're not going to reduce interest rates again unless dramatic things happen in the market, which we're obviously not ruling out, having seen what happened the past couple of years. Why did the market go up then? Well, I think because he also said pretty much, without saying it, they're very good at it, right, that they're not going to increase interest rates. So in a way, I think he knows he made a mistake in increasing the rates successively. Even though we talked about this when it happened, the first rate increase, I was all in favor. But then successive interest rate hikes was kind of too much. So mid-cycle adjustment, he said, he's sticking by it.
Now, as we were reminded, though, the Fed does have other policy tools at its disposal. I know we focus a lot on interest rate cuts, but what about these repos, these repurchase agreements? We know that they're used by central banks to really calm money markets and to really get these interest rates within their target ranges, but we haven't seen the Fed use them since the global financial crisis. Why use them now, and how are they working?
Well, there was this liquidity crunch 2 weeks ago, you recall that, and for that to happen in the United States was not expected. It shouldn't have. It was a technical issue because of the balance sheet adjustments that the Fed has been undertaking. But the bottom line was the market was left with a lot of treasuries, but very little reserves. And the Fed came and provided liquidity to that. But again, the way it was done was very unprofessional because interest rates went up to 10% on that very night.
Right.
So I guess that's one of the reasons that they don't want to utilize these measures that they did before global financial crisis, the U.S. crisis as well. And I believe that because the rules of the game have changed. The level of interest rates have been kept too low. We have about 15 trillion negative yielding bonds out there in the world. So it's not as easy now to just come in there, provide liquidity. You don't know how much, you don't know when. So that needs a little more planning. But I think based on what he said 2 weeks ago about this very issue, they're also planning and coming up with some kind of a mechanism that will actually take care of this.
So then what sort of signals should we be looking at when trying to decipher the actual health of the U.S. economy?
Well, I think it's very difficult nowadays because I did look at for the past 2 months, Rachelle, the numbers that came out, really, if you loaded them up to a computer, it would probably overheat and then short circuit. Because you're looking at, for example, this GDP number, you're looking at retail sales, right? Price of gas is low, but the sales of gas have declined. Then you're looking at vehicle sales. Units of vehicles sold increased, but the dollar value declined. And then you're looking at services, terrible, worst performance services activity in 3 years. Then you look at the employment in the services category, that has improved. And then we have a Federal Reserve cutting rates, dollar is appreciating. So it's a very tough situation to be in. But the bottom line is, I think they're looking at the aggregate numbers, and aggregate numbers are telling a story, and that story is not good. It's only the consumer spending that's holding the U.S. economy now. Just the GDP numbers today is telling you that. But within that number, it's also saying that is slowing down. Right. 2.9% increase this quarter compared to 4.6 in the preceding 3-month period. So I'm not ruling out another rate cut, but if things go this way and maybe a little bit of improvements with the trade issues getting better maybe, right, then we'll be where we are.
And to that point, just quickly, obviously, a lot of people are expecting Presidents Trump and Xi to meet at the APEC summit, which has now been called off. The weakness in global growth and the trade developments, the Fed said that's really what's been weighing on growth. What sort of position is the Fed in right now, given what's going on and that we are not really seeing an end right now to the trade war?
Well, again, they can't say, as chairman, what they really feel like saying, but they also drop in hints, and he's dropped a couple of hints today, too. he said the business investments, the trajectory of business investments got nothing to do with interest rates, he said. So it's pretty much saying it's the uncertainty that the trade situation is creating. You know, Alan Greenspan in 1995 said in the business audience, he said, if I made myself too clear to you, you must not have understood me. So that's the kind of messages that they're giving. They're not being very clear, but yes, the Federal Reserve is watching the trade issues very carefully, and they know that the business investment has been declining in this country for the past two quarters or so, at least 2 months in the monthly data, yes, because of the trade issues.
Certainly, we'll all be watching that. Thank you so much. Always good to have you on. Saruhan Hatipoglu there, CEO of BERI and CGTN's Global Economics Analyst.